Are there certain assets that are getting significantly overvalued because of the way the financial markets are set up right now? And how to recognize these areas? Our guest today is Michael Green, who manages $12 billion of assets at Simplified. He's here to tell us what kind of trends he's seeing and how your 401k could be impacted by all of this down the line.
When you buy the S&P 500 to NVIDIA or Microsoft or Apple, the size of those orders is actually skewing the market behavior even further, causing those companies to rise relative to the rest of the universe. That then changes investment behavior, because if you're the CEO of Microsoft or the CEO of Apple, you're receiving confirmation from the market that your cost of capital is very low, that what you're doing is absolutely the right thing to do. In fact, there's no company doing anything better than what you're doing. That creates, unfortunately, the incentive to then invest as if this market capitalization and this valuation is earned, which is part of the reason why we've seen such an incredible surge in investment in areas like data centers, et cetera. You increasingly hear an open discussion of, will these investments actually generate a return? Most people are increasingly saying, probably not.
I'm Siamak, and this is Market Insider. Michael, it's great to have you back on. Welcome back.
Thank you. I'm glad to be back.
You manage $12 billion of assets. Can you tell us what you see in the economy right now?
Well, as we talked about last time, I think we're increasingly seeing a bifurcated economy, what many refer to as the K-shaped economy, in which some firms are doing exceptionally well, particularly in terms of their stock prices. Other firms are doing less well. And basically, the further you remove yourself from publicly traded equities, the more the world starts to look increasingly dicey, whether those are levered companies held in private equity firms, those are increasingly experiencing financial distress. Some components of that are captured in loan markets, but the vast majority of it is not being properly captured. If you look at businesses that are not publicly traded or not owned by financial owners, small business in the United States is actually struggling tremendously. And again, in many ways, last time we talked about some of the intricacies of the CPI and how that can influence the reporting. The way that we manage our reporting system in the United States, trying to capture the dynamism of the United States, new business formations, et cetera, that's doing our politicians and our policymakers a disservice. We've tried to smooth those components, introducing measures that are candidly just kind of made up, that are influencing our perception on the jobs market in the United States, how small businesses are doing, et cetera. If you have small business owners in your audience, I would suggest that the vast majority of them are experiencing increasing distress, whether that is availability of financing, whether that is shortages of customers, reduced sales that are coming through, competition that's coming from larger competitors. This is particularly true in services businesses like HVAC, plumbing, et cetera, where there's a huge disconnect that's emerging between what you as an individual pay for plumbing services and what's received by people actually going into plumbing to work. That's being driven by horizontal consolidation from areas like private equity, et cetera, that's isolating the profit streams more and more in the same way that we're somewhat seeing in financial markets, where it's growing increasingly concentrated in terms of the financial performance and the behaviors of that. The United States is increasingly characterized as an economy with a growing component of monopolization and concentration across all industries, where industry giants are increasingly determining outcomes as compared to the vast majority of participants. Again, in many ways echoing that K-shaped economy that many listeners are experiencing on an individual basis. We're seeing that play out in financial markets as well.
So big public companies are doing well.
Big public companies, by and large, are doing well, and that's a byproduct of a number of components. But the single biggest component to it is dramatically reduced regulation of antitrust. It's created pricing umbrellas, it's created pricing power where it historically didn't exist. We're seeing that across everything ranging from real estate and rentals, with information are able to effectively exert monopolistic-like behavior, which is the bane of existence of capitalism. Adam Smith identified this in 1776 with The Wealth of Nations, that anytime you bring businesses together, there's a natural desire to collude to raise the relative profitability of capital in business. That unfortunately destroys price information, it destroys competition, which is really what we rely on in a capitalist society to maximize the overall outcomes for all individual participants.
You mentioned that smaller businesses and private equity, they're not doing as well. Is it in terms of valuations or their businesses not doing well?
Their businesses are actually not doing as well. So we are increasingly seeing bankruptcies accelerate and rise in small and moderately sized businesses. I realize this is going to sound like a very large business, but if you look at the behavior of bankruptcies for companies with over $50 million in assets, those are hitting levels that we only experienced in the early stages of 2008. We're seeing areas like downtown regions of various American cities being hollowed out by the loss of retail establishments, et cetera. Anyone walking through the streets of New York will see a shocking number of vacancies. That's going to be even more true in many small towns. Those businesses are at a structural disadvantage in many ways because in 2006, we changed the retirement systems in the United States to increasingly drive investment into public markets. It was what was called the Pension Protection Act of 2006. It established a change in the way that 401ks work. 401ks being the vast majority of the retirement assets that are generated from employment in the United States. There's additional sources like IRAs, et cetera, and they also have some of these rules applied to it. But the Pension Protection Act in particular changed our 401k system from one in which you had to choose to participate, what was called an opt-in system, to one in which you had to choose not to participate, what's called an opt-out system. This had the effect of crowding people into strategies that invest exclusively in public markets, things like the S&P 500 or a total market fund. And it actually went a step further than that. It established what was called the qualified default investment alternative. If you're going to automatically default somebody into an investment program, you have to designate what types of investments they are going to be defaulted into. That QDIA status in 2006 was effectively assigned to index funds. And from that point, we've seen an accelerated growth of index investing across the US spectrum. If you're investing in the S&P 500, that means exclusively you are investing in companies that clear a certain profitability and capitalization threshold. You're not putting any investment into local businesses. You're not putting investment into local communities or smaller companies, et cetera. Even if you're expanding to invest in small caps in the United States, things like the Russell 2000, even there, the cutoff is large enough that effectively any business owner that you know on an individual basis, their business is likely dwarfed by these publicly traded companies. And in many cases, most of those business owners are increasingly looking to areas like horizontal acquisitions, consolidation within an industry, as a mechanism to realize some of the wealth that they've created in their businesses, but that just drives further consolidation.
How much of the investment is coming from these kind of investments that are pushed into the market?
Investment funds, yeah. So the quick answer is that this is the largest pool of assets that effectively exists on the planet. 401ks and IRAs in the United States combined at this point are about $28 trillion in assets. That's both equity exposure and fixed income exposure, so things like treasury bonds, corporate debt, et cetera. But increasingly, those funds are being allocated into investment strategies that simply buy in proportion to market capitalization with no real consideration of what is the forward-looking opportunity for profitability from those companies. That crowding into these investment strategies in my work is largely responsible for the dramatic increase in valuation that we've seen. And the flow of funds has a disproportionate impact on the largest companies, driving down their relative cost of capital, their cost of financing themselves, and their availability of capital to make investments or to acquire other businesses. That has been lowered radically relative to all other companies. And so as a result, these companies are just increasingly advantaged, creating competitive disadvantages for most businesses by number in trying to compete with them for the American consumer.
Does it impact their valuations?
Passive investing absolutely impacts valuations, and it's as simple as understanding what passive investing is supposed to be versus what it actually is. So the label of passive investing, this idea that index investing, since it's buying things in proportion to their existing market capitalization, shouldn't have any impact on financial markets, right? The idea is effectively you're a free rider.
Because you're
on
diversifying based on...
It's not even so much that you're diversifying, it's just that you're doing the same thing that everybody else is already doing, is at least the theory behind it. Now, one of the things I would emphasize is by definition, if you are investing in an index, you are excluding a world of investments that are not in those indices. So if I invest in the total market index, I'm buying roughly 3,500 publicly traded companies. Am I putting any money into the local stationery store or local grocery store? No, but those are assets that are not being properly captured. And so as a result, those companies actually trade at a relative discount, which in turn has helped to facilitate the growth of private equity, which has been built around rolling up or consolidating those companies. But we are withholding funds from areas of the market, right, that should otherwise be receiving investment because we've established a preferred way of investing by government mandate.
So essentially, money is going to the 401ks. People are from the 401ks, it's going to the stock market.
It's going to the stock market and the bond market. It doesn't go to your local businesses. It can't be reinvested in that way, or it's very, very difficult to make investments in that manner. Most people candidly look at the allocations that they receive under the Pension Protection Act, that qualified default investment alternative, or QDIA, today is a target date fund. And if you looked at your 401k, I'm sure most of your listeners are employed, they're working for companies. If they look at their 401k plan, they'll see that there's typically around 10 choices. The 2065 target date fund, the 2055 target date fund, the 2045 target date fund, the 2035 target date fund, et cetera, right? Basically, the only question that's being asked is, when do you plan to retire? Otherwise, we presume you're going to invest like everybody else does. That creates crowding within strategies, and it really, unfortunately, hits at the core of what passive investing is supposed to be versus what it actually is. Passive investing is supposed to, in a theoretical framework, capture all investment opportunities, so small businesses, large businesses, et cetera. Now, that's impossible to do, so we automatically know that we're working within a reduced universe. The second component is that we assume that markets are what's called highly elastic. In other words, they can absorb the flow of funds. And there's some theoretical justification for this, because for every buyer, there's a seller. And as a result, when money flows into the market, it shouldn't have that much of an impact if it's allocated on a market capitalization basis, basically in proportion to what everybody else is already doing. The problem is that's not what actually happens. And so in the last 5 to 6 years, we've actually discovered, through improved mathematics and through improved use of analysis, that the impact of these flows is anything but passive. It actually has a concentrating effect. It drives the value of the largest companies higher more than the smallest companies. That sounds perverse when you think about it, but the reason why is because the impact on price of putting in an order is not tied to the market capitalization of the company. It's tied to how much it trades and how volatile that trading is. Those are the two factors that really play through. And so when you're sending an increasingly large order size, when you buy the S&P 500 to NVIDIA or Microsoft or Apple, the size of those orders is actually skewing the market behavior even further, causing those companies to rise relative to the rest of the universe. That then changes investment behavior, because if you're the CEO of Microsoft or the CEO of Apple, you're receiving confirmation from the market that your cost of capital is very low, that what you're doing is absolutely the right thing to do. In fact, there's no company doing anything better than what you're doing. That creates, unfortunately, the incentive to then invest as if this market capitalization and this valuation is earned, which is part of the reason why we've seen such an incredible surge in investment in areas like data centers, et cetera. You increasingly hear an open discussion of, will these investments actually generate a return? Most people are increasingly saying, probably not. Right? We're actually seeing indications from Google already that things like AI will ultimately become free services supported by advertising, in the same manner that search is a zero cost, quote unquote, zero cost activity, where you don't have to sign up for tons of subscriptions, et cetera. You simply do work by watching ads, and you're then compensated with free search services. We're seeing the direction head in the same way on things like data centers and AI services. Perversely, that means that most of this money is being, quote unquote, wasted, but the market is telling us that it's a fantastic place to invest and a fantastic time to invest. And I would argue that that's largely a byproduct of how we choose to invest, how it's been mandated by the government in a liability-protected manner.
You're mentioning that a lot of money is coming into these companies and causing their valuations to go up. How much do you think is the real discrepancy between what they're valued at, what they should be?
Part of my communication with my investors and others is through my Substack. I actually did an analysis on this in which I tried to look at various tools for valuing these businesses in a traditional framework, on a discounted cash flow analysis or on a return of capital type framework. And unfortunately, the data suggests that these companies are anywhere from 2 to 5 times overvalued overall, which would imply an 85% drawdown at the extreme. And unfortunately, that makes a lot of sense. If you think about a company like Apple, it really hasn't grown its income for give or take 3 or 4 years. Its last growth of income was associated with the COVID surplus and stimulus. It's trading at the highest valuations it's ever traded at in history, suggesting significant future growth opportunities, but this is a company that really has no future growth opportunities. They've outsourced their AI to Google. They have seen very few of their new product developments post-iPhone become meaningful components of their overall revenue. Even things like iPads, et cetera, are relatively small in their business. Accessories like Beats headphones, et cetera, have failed to live up to the promise or expectations. Terrible things like their Vision headset, et cetera, have been largely failures. This is a company that should be trading at a low multiple. Instead, it's trading at a remarkably high multiple. And again, I would assign that to the way that we choose to invest, which automatically sends investment retirement funds. A sizable fraction of those are sent to Apple.
You mentioned that there are investments happening by these companies and they might not get a return.
Well, a really simple example of that is if it actually turns out to be competitive with search, right? So search is a defined source of profits. My behaviors as a leading user of technology, a rapid adopter of technology, is seeing my use of search collapse relative to my use of LLMs, what we call AI. And I think that's likely to continue. If it basically is just a replacement for search, or it's a replacement for other software services that we receive, things like Microsoft Office or email accounts or web page design or all sorts of things that we're finding that AI is taking the place of in many ways, then the pool of aggregate profits doesn't meaningfully grow while the investments have been huge. And so the return, by definition, there is relatively low. That's what seems to be happening, but we can't possibly know the future.
What would be the impact of it if a lot of this investment that's going to these data centers doesn't generate any results?
It really depends on how it affects the macroeconomic environment. If we see cutbacks in these investments, which would be similar to what we saw in the build out of the telecom sector or the dot-com components in 2000, then we would see job loss associated with companies cutting short those expectations, reducing that investment, and that in turn would likely lead to macroeconomic deterioration and a potential correction in the stock market that's not tied to forward-looking components, but simply reflects fewer people paying into the system because there's fewer jobs that are out there. I don't have a strong view in terms of whether AI is going to take a whole bunch of jobs or not. What I know is actually happening is that AI is creating the narrative that allows an increasing number of companies to defer hiring. We're not going to know if we need these people if AI ends up working. And likewise, it's also leading to people not replacing employees who are leaving because they're envisioning a world in which there's much higher productivity, and so they need fewer employees to do the same amount of work. We're not yet at a point in which the prices of providing those goods and services has collapsed, driving a quantity increase that in turn would create the next sort of boom that comes after it. We saw that in the internet when prices collapsed for data services post-2000. Today, we take for granted that we should have cheap and available bandwidth that allows us to do all sorts of things using telephones and computers that candidly we couldn't have imagined before, including things like distributing this broadcast over the internet. That's something that 25 years ago would have been prohibitively expensive. Today, it's effectively zero cost.
You mentioned the private equity, that now a lot of money is going to private equity. Can you tell us what you see in that space?
Well, the problem right now actually is that a decreasing amount of money is going into private equity for two reasons. One is that ultimately the capital that is invested in private equity has grown dramatically over the past several years. And so today many institutions, individuals, family offices, et cetera, find themselves over-allocated to a relatively illiquid asset class in which they are increasingly concerned about the return of the capital that they have invested into those areas. When the narrative emerged that private equity had higher returns and less risk, and certainly published results contributed to that, more money flowed into those areas. That increased the competition for the available investments, raised the prices associated with those investments, theoretically reducing forward returns. But the much bigger story that actually played out is the ability of large privately held companies to go public and obtain liquidity and make that transition into the public markets is increasingly capped by the very phenomenon that we were discussing before. A passive index, by definition, does not include those companies when they list and go public. And as a result, there is no bid for those assets coming from that marginal flow of capital that's going into index investing. That makes it very hard for companies to go public. It's why IPOs remain in trough levels relative to equity markets that are at all-time highs. Historically, those have been very strongly concentrated. But when the money is directed through passive investment vehicles, there's no mechanism for investors to effectively step aside from that benchmark to invest in this new promising IPO. That requires a robust active manager space, which unfortunately is increasingly being hollowed out.
Can you explain how does private equity work?
Yeah, so private equity used to be called LBOs or levered equity. That took on bad connotations in the aftermath of the RJR Nabisco buyout. I encourage your listeners to go watch, Barbarians at the Gate or read the book. There was a period in which the use of the term leverage became unattractive. And so they rechristened it private equity, which simply means it is an equity fund in which you have contributed a defined amount of money. That money is then used to make acquisitions as the equity investment into a levered acquisition. So I can take my $1 billion private equity fund and I can lever it 6 to 7 times and control somewhere in the neighborhood of $7 billion worth of assets with that $1 billion of equity. That's what private equity means, is it's referring to the fact that those are privately held companies where it is an equity investment to gain control of those assets. The idea behind it is very straightforward, right? As a private investor, as somebody who is focused on these, I'm stripped of the day-to-day noise from public markets where prices are changing on a daily basis. And theoretically, it allows me to focus on how to improve operations and think a longer-term framework. Unfortunately, the evidence is very weak in support of that assertion.
So the idea was to come in, buy companies, grow them,
improve their opportunities, grow them, create additional opportunities,
more acquisitions.
And unfortunately, what we've seen is it's largely been a function of financialization, increasing the leverage of these companies, increasing the amount of debt that they're carrying, not meaningfully improving their operations other than things like horizontal acquisitions in which you're cutting out layers of costs associated with management and theoretically enforcing greater price discipline on the rest of the industry as you grow and scale. But there's not a lot of evidence of operational improvements, which really shouldn't be a surprise. Candidly, Harvard MBAs, for that matter, Wharton MBAs, are not particularly good at running companies. They're awfully good at doing the financial analysis in terms of how we could acquire them and what level of indebtedness we could incur that would allow this to be a profitable investment from an equity standpoint. But none of those individuals have any real operating expertise. They don't really know how to fix these companies.
You mentioned the opportunity for these companies to go public now. It's harder for them.
It's much harder.
So there hasn't been a lot of exits in the private equity. What's going to happen in this space?
These companies do have to exit, so there's a finite life. There's a number of techniques that people are now attempting to extend the life of these investments. There's what's called continuation funds, which are new private equity funds that are created to buy the assets of the old private equity fund, ostensibly generating returns. There becomes a question of fair and legal transfer pricing. Are we actually acquiring it at a fair price given today's higher interest rates, given today's economic outlook? Or are we effectively subsidizing the exit from a prior generation of investors, which would fall into what's called Ponzi finance components? There's also just the element of keeping those assets under the management of the private equity investors, which allows them to continue to earn management fees, which are charged at very high levels across these assets, and basically create a agency problem in terms of what are the incentives of the private equity company versus what are the incentives of their investors. What's the objective of the private equity company versus its investors? Increasingly for the private equity company, it's let's just make sure we continue to generate asset management fees.
What about gold and silver? There's been significant moves in these assets. What are your thoughts on the movement?
Well, I think unfortunately part of what has happened with gold and silver is that it is an opt-out investment. It is the tool that people use when they say, I don't believe any of this anymore. I don't trust people. I don't trust counterparties. Gold is a metal. It's an element on the periodic table. Silver is the exact same thing. They've historically been used for coinage for exactly that reason. They had certain physical properties that made them particularly valuable and useful for things like coinage. Gold in particular was useful for large format coinage because it was very difficult to counterfeit. We know its atomic weight, so if we weigh it, we can actually identify whether the material is real or not. It has physical properties that lend itself to coinage, particularly in historic times. It's relatively malleable. It could be stamped as compared to having to be melted down, which is very expensive in terms of energy acquisition costs, particularly if we're talking about 0 BC. Those sorts of components have led to the perception that this is quote unquote money. It's treated as such on many financial balance sheets. And so in 2022, when the United States decided to impose sanctions on Russia and effectively took the treasuries that the US government, that they had bought from the US government or in the secondary markets in response to trade surpluses that they had generated, when we took those away, we sent a signal to the world that basically said, you can't trust the assets that you've accumulated from the US government. That led to particularly countries like China choosing to diversify their reserves, the incremental income that they were generating from growing trade surpluses, into areas like gold. For the first year or so, that was met by selling from the US retail and other retail investors who saw prices rising as an opportunity to enhance their liquidity, reallocated to more sexy or more interesting areas like Bitcoin or the NASDAQ or other components of it. But really starting around 23, 24, that behavior exhausted itself, and then you had both the Chinese and foreign national governments buying gold, and the US retail investor began joining them. That's caused prices to rise significantly. And I think the more important component here is not whether gold has intrinsically raised its value because of money printing or anything else, but more a function of people saying, I'm checking out. I'm doing something that I don't have counterparty risk. At the end of the day, gold is a commodity. It is going to remain an element. Whether the US government prints more money or not has no material impact on the actual element or metal itself. And people are increasingly saying, I don't trust the system. And so I'm going to go to the asset that historically I could use to opt out of investment opportunities. Gold is a good illustration of that.
Do you have any thoughts on people that are looking at gold and silver? Do you have any thoughts for them?
I think it's very, very hard, right? I have a different view on gold. I tend to be skeptical of whether the US government can efficiently and effectively address many of the concerns that we discussed, whether it's tied to policy around the poverty line or concerns in geopolitical frameworks, et cetera. I think our behavior is increasingly erratic, and so I'm very sympathetic to people's desire to effectively take the resources that have been generated through the American experience, whether that is trade surpluses from China or whether that is individual incomes or earnings or wealth, and effectively try to step outside the system. There is a mistake that people use when they talk about gold as money. That's a historical anomaly. John Maynard Keynes called it a barbarous relic. I unfortunately think that he's largely right. It's a belief system, right? It's the idea that this was money. Money or currency, actually in financial terms, has one purpose and one purpose only: to cancel debt. If you pull out a dollar bill or a $100 bill from your wallet and you look at it, you'll see printed on it, this note is legal tender for all debts, public and private. That's what it exists for, is to cancel debt. Those debts can be micro debts. I order a coffee at the coffee shop. I've incurred an obligation to pay for it. When they deliver it to me, currency is what's used to cancel that micro debt. It can also be used to cancel the debt that I have on my house, called a mortgage. It can be used to cancel the debt that I have to my government in the form of taxes that are due. The real question is the US government making policy choices and decisions that ultimately mean it won't be able to effectively tax people? That's the bigger question. And unfortunately, we're seeing some pretty strong evidence that when push comes to shove, if you're a large taxpayer, you can negotiate special terms or avoid it entirely. That's a sign that the government is losing control. And under that framework, it makes perfect sense to opt out. I think it's counterproductive for us as a society, but I think it's an important thing to recognize the validity of that expression, that people don't like the direction that things are going. That pushes more people to buy gold with a relatively finite supply relative to the supply of money. You see people ultimately converting that into what they presume is an asset that will outlast the US government.
You mentioned Bitcoin. What are your thoughts on crypto?
Well, so those are two very different topics. So crypto and Bitcoin are conflated, but they're not really the same thing. So crypto simply refers to cryptographic instruments or cryptographic assets. The dollar is a cryptographic asset. It has a serial number that's written across it that says this is the unique expression of this debt cancellation capability. This is an individual identified security with that serial number that you see on there. That's cryptography, as are, by the way, the watermarks that exist in it, the markings of Washington versus Lincoln versus Franklin, et cetera. Those are all cryptographic components. Stock certificates have the same thing. Cryptographic assets, crypto more broadly, refers to digitally native assets. So that cryptographic capability is embedded in an algorithm and it all sits in a digital realm. There is no paper equivalent of it. There was a period of time when people would buy physical representations of Bitcoin because we're so used to thinking about it in those terms, but it really is ultimately just a series of numbers or a digital asset. In a world with extraordinary computing capability, that actually takes on really unique features and suggests that this idea of digitally native assets or tokenized assets is going to be increasingly important. When you think about many of the products that we take for granted, a mortgage, for example, most of your viewers will be familiar with movies like The Big Short. Really what's happening within mortgages is we're creating products that can be traded on a statistical basis by lumping together your individual mortgage with millions of other mortgages, really thousands of other mortgages. A typical residential mortgage-backed security will incorporate tens of thousands of individual mortgages which begin to behave with statistical properties. Those assets, though, importantly, remain analog paper-based instruments. The requirement to produce a residential mortgage-backed security is that I actually accumulate the physically signed documents. I can then digitize them by feeding them in, but they are at base a paper-based document that has to be stored in an Iron Mountain facility. Each residential mortgage-backed security has about 3 million pages that are stored in physical form somewhere for it to be physically legal. That's actually your competitive barrier. Not many people have the capacity to accumulate 3 million pages, store them in an Iron Mountain facility, digitize them, and encapsulate all the components that are required to list that security, that RMBS. That's a barrier to entry. The minute you move to digitally native securities, if I enter into a mortgage that is actually embedded on something like a blockchain in which there's multiple copies of it distributed throughout the world that says these are all the components of it and it's actually embedded in the digital signature asset, that becomes much easier for people to create new products around it because all the characteristics are already digitized. There is no physical storage of the asset. That is absolutely going to take the world by fire, and we're already seeing that start to happen. As a financial investor, I'm incredibly excited by that world. Bitcoin was basically the Nina Pinta and Santa Maria of New World discovery in this. It was one of the first assets that had these characteristics. But it was built under an ultimately flawed premise that scarcity is what creates value. Ironically, scarcity as it relates to payment capability and as it relates to transactions is the enemy of value creation. The reason the dollar is used as the world's settlement layer is because it is so universally distributed and available. It's the lack of scarcity that actually creates the value. Now you can oversupply that dollar. You can create conditions under which there is no debt that cannot be serviced immediately and easily because we've printed so many dollars. That would be a mistake in terms of what we're actually trying to do from a policy standpoint, but it's a natural response to crisis. Right? What happens in a crisis is assets are destroyed, people's liquidity is destroyed, their capacity to service their debt is destroyed. And so one of the mechanisms of kicking that can down the road is to simply print more money. Right? And that's, by the way, the characteristic that we've seen in every crisis that's ever occurred. It's part of the reason why it contributes to inflationary conditions, because it's allowed more assets out there that cancel those microtransactions, right? I have more currency that can be used to cancel that coffee transaction that I described before. Therefore, more people have access to it. Therefore, the price of coffee goes up. It's an unintended consequence of response to crisis that is created. It's not actually the money printing that causes the inflation. It's what it ultimately means. Bitcoin effectively tried to deal with that by saying, we're going to have a finite number of this. The problem is in an infinite world, and we are largely an infinite world where population continues to grow, new entrants constantly enter into the system. Anything that is truly finite in its construction is automatically creating incredible scarcity for future market participants. Children that are born into the world without Bitcoin effectively need to sell themselves under punitive terms in order to gain access to that Bitcoin. That's very different than a fiat system that is constantly creating new assets and distributing them. We could be doing that badly. We could be doing it for bad reasons. But it's not creating the artificial scarcity that something like Bitcoin does. Bitcoin, because it's a computer program, you can run a simulation of it on a forward-looking basis. I did this roughly 2017, and what you discover is that contrary to all the narratives around Bitcoin, yes, the price of Bitcoin will appreciate, but the consolidation of holdings in Bitcoin will accelerate, raising what's called the Gini coefficient, or the inequality within the Bitcoin universe. And that's unfortunately exactly what we've seen. Bitcoin, and in many ways most fiat systems, are a little bit like the game of Monopoly. You can play a game of Monopoly, but new entrants really struggle in that game of Monopoly unless you effectively give them enough currency, money from the bank, to allow themselves to compete. You redistribute some of the properties. Otherwise, the game ends very quickly for new entrants. They get $200, they try to go around, they land on Park Place with a hotel on it, they lose all their assets, they file for bankruptcy, game over for them. Right? That's the experience that many young people are having today. We've failed to adequately provision them to be real participants in the economy. And unfortunately, the enforced scarcity and language behind Bitcoin, et cetera, would simply perpetuate and accelerate that. And that's unfortunately what we're seeing. It's not being broadly used as a transaction layer. It's not being used to cancel debts in any meaningful fashion. It's largely being used as a speculative digital number on a screen.
With what you're seeing in the markets and the economy, do you have any advice for the investors?
Well, I think the single most important component that I encourage people to think about is what is actually the endogenous liquidity within your portfolio? What is the capacity of that portfolio to return cash to you without you having the availability of liquidity to sell it to somebody else? Because unfortunately, that's what my work suggests, that ultimately what we will end up seeing in public markets is markets become more concentrated and passive, where the flow determinants simply reinforce concentration in markets and increased valuation for the largest companies in particular, but broadly all publicly traded companies, that wealth doesn't really exist, that the capacity to generate cash flow from that wealth in the absence of being able to sell it to somebody else is increasingly diminished. And so I just encourage people to look at the assets in your portfolio and their cash generation capability and ask yourself if you're satisfied with the ability to generate cash from your portfolio, even if you couldn't find anyone else to sell it to. I think there's very few people that would actually feel comfortable with their portfolios at this point. That's why we see many of the shenanigans like call overwriting strategies to increase incomes, use of derivatives to increase their incomes. These are all ways of taking on additional risk in portfolios to allow you to generate more cash from the portfolio than it's currently generating from itself, dividends, share buybacks, et cetera, or interest payments on debt. Those are all increasingly challenged and in question. I think, unfortunately, that tells me that ultimately valuations should be a lot lower, and much of what we take for granted as wealth is somewhat specious in its construction. We're not as rich as we think we are.
So when you mention cash flows, should they look at the ones that are actually paying dividends, or should they just look at the income and cash flow of the companies?
Well, this is unfortunately the problem that's created when the government blesses a particular style of investing, like passive investing. Remember the Keynesian beauty contest is referring to John Maynard Keynes' observation about how the stock market works. It's not actually your analysis that matters. It's you figuring out what the analysis of the next marginal player is going to be. So when you have an environment in which people are being forced through employment terms and the construction of things like 401ks and the fiduciary rule and the implications for things like IRAs and other investment opportunities that they have, they need to recognize that part of what's happening is that everybody else is being forced into a particular style of investing. Now, perversely, that actually creates momentum characteristics that mean that the most profitable investment is basically predicting, is this going to continue to be the case, and stay invested in things like the S&P 500, not the actual value itself. That will ultimately matter. It just doesn't matter yet.
So you should pay attention to the actual value of things you're buying.
I would encourage people to continue to develop the skill sets to allow themselves to evaluate their investments and understand what are the cash flows that will be generated in the absence of somebody showing up to buy it from you. It doesn't matter for right now.
Michael Green, Chief Strategist at Simplified Asset Management. It was great to have you on Market Insider.
It was a real pleasure to be here. Thank you for having me again.
What do you think of this conversation with Michael Green? Do you agree that certain assets are significantly overvalued based on the way we do investing in the markets today? Let us know in the comments. I'm Siamak, and this is Market Insider. We'll see you next time.